All right, let's dive right into what I like to call the seductive trap of billionaire stock headlines, and how so many of us everyday retail investors get completely lured in. Welcome to this explainer. Today, we're breaking down a really fascinating framework called Beyond the 13F, the art of smart money tracking. And honestly, this completely dismantles the way most of us look at institutional investing. If you've ever felt that sudden urge to just copy a famous investor's moves, well, this is going to fundamentally change your entire perspective.
Picture this. A major quarterly 13F filing drops, and instantly you see a headline flashing these massive market-moving trades from Berkshire Hathaway. Alphabet is up 204%. UnitedHealth is completely exited. Chevron slashed by a third. The natural instinct for millions of retail investors is to race straight to their brokerage apps to mirror those exact trades. I mean, it makes sense, right? If the smartest money in the room is doing it, shouldn't you be doing it too? Well, hold that thought.
Because here is the brutal reality, which our source material perfectly dubs the 45-day lie. By the time you read that headline and look at that filing, those trades are at least 45 days old. Think about that for a second. 45 days. That is literally an eternity in financial markets. The guru you're trying to copy right now could have already completely reversed every single one of those positions. And here's the kicker. Nobody, not the SEC, not the holding company, not the financial press, nobody owes you an update. Acting naively on this delayed information is without a doubt one of the fastest ways to lose your capital. Section 1. What 13Fs actually hide? Or the fighter jet metaphor. You see that 45-day lag? That is just the tip of the iceberg. It's just one of the many reasons why tracking smart money naively falls apart. A 13F filing is not a complete portfolio statement, not even close. It is merely a partial X-ray of a long-only U.S. equity slice of a portfolio. That massive remaining chunk, what we'll call the invisible portfolio, holds the actual secrets that make these institutional strategies work in the first place. So what exactly is lurking in that massive invisible slice? Well, first off, there are 0 short positions reported. An investor might look incredibly bullish on Apple in their 13F, but for all you know, they could hold a massive, completely invisible short hedge against it. There's also no fixed income, so bonds, treasuries, and credit positions. They simply don't appear. No foreign holdings either, meaning Tokyo-listed semiconductor stocks are totally hidden from you. Pooled mutual funds are masked as cash equivalents, and small, de minimis positions can legally be left off the report entirely. When you realize all of this is hidden, you quickly see that acting on a 13F is literally like trying to fly a fighter jet by looking at just one wing. You don't have the full aerodynamic picture and, well, you're going to crash. Which brings us to Section 2, the 8 intelligence sensors. The absolute crucial takeaway here is that we have to stop treating 13F filings as step-by-step instruction manuals and start treating them as a sophisticated sensor network. The source material outlines 8 distinct sensors for us. First, Buffett's 13F gives us a fantastic long-term value lens. Then you have Druckenmiller, who provides crucial macro calls on currency and rates. Dalio totally shifts the perspective, giving us a risk parity framework for asset class diversification. Now, if you want enormous conviction on highly concentrated bets, Ackman is your sensor. Over on the venture side, Peter Thiel and Founders Fund offer anti-consensus, often years-early tech picks. Cathie Wood is super fascinating in this framework. Her funds are actually often best used as a contrarian signal. Stepping away from traditional funds, we have Polymarket for real money predictions on geopolitical events. And finally, dark pool prints and unusual options activity, which allow you to see the actual unvarnished money flow. Now, each sensor is partial, each one is biased, but when you combine them into a single dashboard where they cross-reference each other, they become incredibly valuable intelligence.
All right, moving on to Section 3, myth versus reality, and exactly why copying fails.
To really completely dismantle this myth of just copying trades, we have to look at the structural realities at play. Even if you magically had perfect transparency, mimicking the moves of billionaires is mathematically stacked against you because of some massive structural traps. First up is survivorship bias. We really only talk about Buffett and Ackman because, well, they won. The graveyard of 13Fs is absolutely packed with failed gurus you've never even heard of, making pattern matching statistically broken right out of the gate. Then you have strategy mismatch. You cannot realistically replicate the trades of a 90-something billionaire who holds positions for literally decades, sits on massive insurance float, and has functionally infinite tax deferral, especially not when you're working with W-2 income and staring down a 36% short-term capital gains rate. Finally, there's the Warmer's 2003 peer-reviewed study. It proved that when too many investors mirror a fund, the fund's own future returns actually deteriorate. The signal literally eats itself. When thousands of retail investors copy a trade, they artificially inflate the price, completely destroying the original edge. And if you want a perfect example of this, just look at how the exact same picks by the exact same person get wildly different labels over a simple 4-year timeline. This is the Cathie Wood paradox. Back in 2020, her funds were lauded everywhere as the ultimate smart money. Fast forward to 2022, and the media labeled them dumb money. But then come 2024, suddenly they were smart money again. Guys, it is the exact same person with the exact same strategy. This proves beyond a shadow of a doubt that media labels are just pure noise. You have to look past the flashy label and analyze the underlying signal. Let's put this into practice. Section 4, Decoding the Berkshire Receipt, specifically looking at Q1 2026.
Okay, let's apply our new framework to a real-world scenario to see how this is actually done by the pros. The naive trap is treating the filing as a simple buy or sell alert. Oh, Berkshire bought Alphabet and sold Chevron? I should totally do that too. No, don't do that. The sophisticated investor, on the other hand, reads this strictly from macro direction and conviction. They ask a much better question. What is the smartest long-term capital allocator on the planet actually signaling about the state of the world right now? Let's break down 3 really sophisticated signals from that exact filing. Step 1, we see consolidation. Berkshire shrunk from 40 positions down to 26. The signal there? In an expensive market, even the absolute best are pulling back and reducing their bets. Step 2, embracing megacap tech. After years of avoiding the AI complex entirely, buying Alphabet signals that the traditional value template can actually now accommodate compounders with massive AI moats, even if they're sitting at higher multiples. Step 3, cutting energy and managed care. Trimming Chevron significantly signals that the easy money thesis on integrated oil might finally be nearing its end. Do you see the difference? Instead of trading specific tickers, you extract the high-level macro posture. And honestly, this brings us to the core philosophy of this entire explainer. Smart money is intel. It is not instructions. You read these filings to understand how massive capital is positioning its overarching sector posture, not to just clone an individual ticker. Because at the end of the day, a 13F is just a receipt of a transaction that was made 45 days ago. If you treat the receipt as the trade, you are basically paying retail for institutional leftovers. So before you go out and make any real money decisions or even talk to a fiduciary to plan your next moves, I really want you to stop and completely reconsider how you track the market. Think back to the sensor network we built today and ask yourself, which of these 8 inputs are you actually actively using to build your own independent thinking? Are you relying way too heavily on delayed 13Fs, or are you maybe utilizing prediction markets and dark pool data? Or do you just ignore all of them entirely? It is an absolutely vital question to ask yourself as you try to navigate the constant noise of modern investing. Thanks so much for joining me on this explainer, and remember, keep your sensors sharp.